Hello, and welcome to RiskScout's webinar, Learning from Silicon Valley Bank and Signature Bank, Contingency Planning and Complex Markets. We are so excited that you're joining us today. Before we dive into today's content, let's run through some quick housekeeping items. RiskScout will be sharing all of the webinar resources, including slides, handouts, as well as the recording in a follow-up email, so keep an eye on your inbox. We also want these sessions to be as valuable for you as possible, so we encourage you to ask any questions you may have throughout the session in the questions section of the webinar panel on the right side of your screen. We'll also be running a few poll questions throughout the webinar to help better understand our audience, so your participation is greatly appreciated. For those of you that are joining us for the first time, RiskScout is a team of former bankers, regulators, and industry experts that have joined together to help community financial institutions unlock complex markets to increase deposits from their own backyard. Through both software and services, RiskScout reduces the time, effort, and uncertainty around expanding into new markets so you can increase your footprint without opening new branches. If you're interested in learning more, visit riskscout.com and get in touch. Next month, RiskScout will be hosting the free webinar, Banking FinTechs, Knowing the Risk for the Reward, on April 19th. With the FinTech as a service industry expected to be worth over $900 billion by 2030, it's no surprise that community financial institutions are beginning to wonder if the risks are worth the reward. Join this session to learn how you can leverage comprehensive reviews, policies and procedures, as well as tools to help reach your institution's growth goals through FinTechs. Today's session will be led by Kristen Parker, RiskScout's Director of Compliance, and Ryan McInerney, RiskScout's Product Strategy Principal. Prior to joining RiskScout, Kristen worked on both fraud and BSA teams, where she successfully created and implemented one of the first Federal Reserve Bank approved hemp onboarding and ongoing monitoring programs. Ryan McInerney joined RiskScout's product team after working as a national bank examiner with the OCC, where he helped to identify changing industry trends and risk conditions, particularly around compliance and commercial credit. We are so excited to have them joining us here today. Now, before we dive into the specifics around these bank collapses, we would like to go ahead and actually ask our first poll question. You should be seeing this poll question come up on your screen currently, and that question asks, how are you feeling about the current banking environment? You can choose any of these four options, and those options are, I'm feeling optimistic, I'm scared about the future, I'm somewhere in between scared and optimistic, or I'm not sure. That's why I'm here. I'll give you all a couple of seconds to get these votes in here before we discuss. Excellent, excellent. We all are quick on the draw. Looks like we have most of our responses already in. Let's take a look at what our audience said today. It looks like the majority is feeling somewhere in between. We've got a mix of feeling a little scared, feeling a little optimistic, but that's followed pretty close behind some optimism there. So only about 2% of our audience is feeling ultimately scared as their primary, 21% still on the fence. Ryan, if you don't mind me asking, how does this stack up to what you were expecting? Is this in line with what you've been seeing in the market?
Yeah, I'd say this makes sense to me. And I'm gonna toss my webcam on so y'all can see me. But yeah, I think this makes sense. You know, there's been a lot going on, and we're not 100% sure looking forward. Is this going to be something that continues? Is it starting to get better? So I understand kind of that purgatory type response being the most common. Makes sense.
Absolutely. Thank you for that insight, Ryan. And thank you all for your participation. Like I said, we will have a few more polls throughout today's session, so keep an eye out. But without further ado, I will go ahead and throw it over to today's presenters. Kristen, take it away.
Thank you, Ethan. Guys, it's good to be here with you today. I'm happy that we get to share our faces with you now too. So it's finally good to get on camera with you guys. For those of you that have been coming for several years now, this would be our first. So we wanted to go over these very important subjects with you because it's obviously the talk of the town. It's the biggest, you know, I can't get on LinkedIn without somebody mentioning something like this. And we think it's important to kind of put this whole situation in context for you guys that is digestible and understandable and then actionable for you. And then look at different areas where maybe you can pivot your own institution to maybe take part of, you know, the failures of this or these two institutions and pivot them in a direction where you potentially could benefit from it, which is not the nicest term to use and when you're talking about bank failures, but we're trying to always be the optimist here and think what's the best you can do for your institution to protect you guys from getting in the same situation, but also what can you do and potentially gain from this situation that happened between these two, and I guess basically three institutions that one self-liquidating into two of these bank failures. So in a quick overview of the recent bank failures, we have had two sizable financial institutions collapse this month or in the last month or so, including the second largest bank failure in the nation's history. So we're talking about Signature Bank of New York and Silicon Valley Bank. But the ripple effects that can occur through the financial industry, and it can very much happen on a really fast, quick pace, how quickly the ripple effects take place. And we saw that happen quickly after SVB went down and then followed up shortly after by Signature Bank of New York. How quickly people became scared and started to go into their own community financial institutions and start withdrawing their funds from that. So we need to talk about how that piece of it needs to be addressed in your contingency planning as well as to how do you guys react as a financial institution when there are other institutions that are taken down in this manner. And then understanding it is really the key to mitigating those risk factors for you guys long term. From depositor confidence, liquidity, and credit availability, that's just a few of the factors that come into play here when we're talking about these failures. So we will talk deeply about the banker's perspective of it and the examiner perspective of it and tie those two together for you guys so you can create an action plan here for your institution going forward. All right, Ryan.
All right. So going into what happened, when we're looking at Silicon Valley Bank, and we're just going to kind of look at this as the broader focus point, we'll tie in some of the things that might have been happening at Signature. There was a question I know that someone submitted early about Silvergate. But when we look at Silicon Valley Bank, we're talking about a situation where there's a lot of long-term interest rate risk exposure. So if you're ever working with your CFO and those kind of risk management type reports, you'll typically see economic value of equity measurements. And so that economic value of equity is essentially the theoretical liquidation value of your institution. And so here we probably had a pretty high risk EVE calculation, which is the economic value of equity. And that's brought in by losses that have been unrecognized, unheld to maturity portfolio investments. So I'm sure y'all have heard that a lot. If it's ever a metric you want to look at, if you go into the call report on any financial institution in accumulated other comprehensive income, you can find those numbers. But essentially, as depositors started pulling out of the institution at a rate that was higher than expected, Silicon Valley Bank was forced to sell a lot of these assets, recognize the losses, and deplete their capital, eventually getting to the point where they ended up going into receivership. So that's a situation, whenever we look at these liquidity crises, they happen overnight in a day or two, and it can be a little jarring to watch the speed that these occur. Kristen, anything to add there?
Yeah, I'd say the speed of this bank run was probably one of the faster in history, and it was stemmed by very interesting things that happened over the week before the Friday that they ended up closed. So I think we're going to get a lot more uncovered from how this all fell into place. There's a lot of rumor mills going around of who's to blame, and we'll see that outcome eventually play out, I'm sure. But social media is a big tool here in scarcity, right? It's why we all ran out of toilet paper so fast during the pandemic, right? It's we get into panic mode as people, and we want to protect ourselves, and it's exacerbated by the ability for news to spread so quickly. And then you get some powerful people spreading that same message and kind of putting the fear factor in people, and that's how quickly a bank can be running one day and then gone the next. So
yeah,
it's really, that should be part of contingency planning as well, is how do you quickly turn those talking points around to ensure that your depositors know on a reoccurring basis that you're not the same as these institutions, and nor is that in your trajectory to be the same.
Now, I think this, so I wanted to put in a video of It's a Wonderful Life in here, because It's a Wonderful Life has the bank run scene in there, and they start talking, well, your money's in Jimmy's house and your money's in Johnny's house. And essentially then you have to start liquidating assets to meet those demands. Similar idea behind the Silicon Valley Bank failure is you have a lot of depositors starting to pull out of an institution at a rapid rate. When we look at both of the situations, we're talking about deposit concentrations that are higher than you would expect on average for a financial institution. So in Silicon Valley Bank, a lot of that was related to venture capital, the tech side of things, and kind of transpounding different industry verticals. So maybe some of those concentrations were a little bit broader than might have been expected. And then on the Signature Bank side, it was the crypto deposits, the crypto concentrations starting a run, and then more of the customers starting to see that happening and kind of that panic, that frenzy of scarcity. So luckily, it's not toilet paper we're talking about here, as Kristen mentioned, but I think it's a little bit more dangerous when we start talking about the liability side of financial institution and people are scared. One thing that I think is kind of interesting in that is when we think about, say, the FDIC insurance limits, those limits have been the same for a very long time. And so we're starting to see those deposits are above those numbers. And that's another reason that some of that scarcity conversation comes into play, because money's at risk. And if they're afraid they're going to lose it, then people start pulling things out.
And Ryan, can you speak a little bit to there being the rules around how much you have on deposit versus how much you can lend out, and kind of speak a little bit to those numbers and what the previous expectations were and when those changed?
Yeah, so I think what you're referencing is the leverage ratio. So the leverage ratio that a financial institution has. When we think about capital ratios, leverage ratio in general, that's all informed by Basel. And some of that started to shift after the financial crisis in 2008. So we think about the amount that you have to have on hand when you start to get below some of these numbers. There's going to be, say, your well-capitalized level, and then you go all the way down to basically critically undercapitalized. When you get to that point, that's when you end up going into receivership. So one of the things we talk about, say, in stress testing, that sort of thing, is looking at what are the impacts you might have looking against those capital ratios. And particularly, I think a good one to look at is that leverage ratio, because that's going to be the least forgiving in terms of rating assets different ways because of their risk weighting and that sort of thing.
Perfect, good.
Okay, now this is a fun one. So concentration risk management, if you're in a community, mid-size, I mean, even large financial institution, I think we've all heard the things about concentration risk management. And so in 2006, CRE, commercial real estate concentrations, were one of the biggest focuses for examiners. I know when I started my examination career, concentrations remained at the forefront of one of the things that we look at the most. And so we would report any concentration over 25% would be in an appendix in the back of our report of exam that we would give for that financial institution, showing what the concentration was in. And so that's above 25% of tier 1 capital plus the allowance, if anyone's curious. Now, some of the things we'd be looking at in those concentrations might be different industries. So we'd subdivide that into, say, if it's hospitality, maybe it's restaurants, maybe it's something else. but looking at those industries in general, because if there's a broader industry move and something happens in there, what's the exposure to the financial institution? Then we'd look at it as CRE in general, and then we'd also look, say, as geographies, by employers. Particularly on the deposit side, we would say look by employers if you're in an area where maybe there's a very large employer that has an outsized impact on your deposit base. So if I have let's say I'm in a $1 billion community bank, and there's 2 or 3 very large companies around me. Maybe it's like Walmart's manufacturing center and some other big box retailers that have thousands of employees in the area. That can make a huge impact on your deposit base. And so what would happen if there were layoffs or something like that? So those are some of the things we're thinking about when we're looking at those concentration bases and how they might affect the liability side of the balance sheet. But primarily this has been thought about on the asset side. And I think it's going to become more and more prevalent that we're going to have regulators looking into concentrations on the liability side.
Yeah, and we've been actually having a lot of conversations with that from the services side of RiskScout, of even prior to those bank failures, more and more people becoming concerned or interested, and maybe that came bubbling up from their regulators, conversations that they have maybe on a reoccurring basis with their regulators, that was coming down the pipeline. But we're started to see that prior to this happening, and now it's just like wildfire. We're getting calls left and right to help people think through these ratios and do some contingency planning around concentration risk.
Okay, so stemming from the concentration risk side and then kind of bubbling that into the contingency planning side of things. I mean, I think there's been a lot of conversations, and you'll see it in the news, you'll see it in different articles, like, well, what were they doing on the contingency funding planning side, and why didn't they have a plan in place for this? And it gets to a point when there's a large enough run on the institution, it really doesn't matter what you've done on your contingency funding plan side. If you pull out half of the deposits out of a financial institution, it's really hard to have a plan in place to replace half of your funding. But typically when we're looking at the contingency funding planning, what we're looking at are things like concentrations, whether those are the employers, whether that's by industry, and we're looking at high risk or volatile deposits. So when I say high risk or volatile, a lot of those are going to be deposits over the $250,000 FDIC insurance threshold. Another item that might be up there would be any rate sensitive deposits. So if you're using CDARs or brokers, those are going to be more apt to leave, even though they're within that insurance limit, because they're always chasing that highest rate. And so if you can't meet that rate, then you might lose that funding source. Another might be, say, municipal deposits, as those are going to ebb and flow with seasonality, particularly around the collection cycle. So thinking about what those different concentrations are and what they mean for your funding source, and then how would you replace them? So you're going to have non-core funding sources, which might be brokers, they might be FHLB borrowings, it might be something else, some other sort of line that you have to get funding for your financial institution. Looking at that against the actual high volatility deposits you have and saying, you know, would that be adequate to cover this? And if it's not, and I had to start liquidating assets, what's my exposure from a held to maturity loss perspective? How would that impact capital? And then how would that capital impact put me in relation to those well-capitalized capital triggers that we talked about before? So it's kind of waterfall of stress testing when you start to look at these things going down the line. That's why it's important a lot of times that we see people talking about enterprise risk management and looking at what's happening on the finance side, what's happening on the credit side, really linking those types of metrics together. Now, one of the things we cared about and what we check a lot at the OCC was, how have you tested your funding lines? Are you sure you're able to access these? Sometimes you have entities that say, yeah, I've had this line for 20 years, but they've also never drawn on it. So if there is something that would have been missing from it, they're going to find that out when they actually need it at the last second. So taking small draws, just making sure you know the process, you know what you're doing, and they have the information they need from you to do that sort of thing is best practice for sure.
And how often, Ryan, would you suggest that they are doing stress testing and those type of testing against their own contingencies?
Yeah, I mean, when we look at, say, liquidity risk monitoring, that's typically done on a quarterly basis. You're just running the same numbers every quarter, and that's a report that's being surfaced up to the board of directors. A lot of times we'll have institutions do that, and they'll have some early warning indicators, usually like 3 levels. So it might be green, yellow, red. And as you start to approach that limit is when you start to take action plans to say, you know, we're getting close to this. What are we going to do to make sure we don't breach it? Because when we do breach it, that's a bigger problem.
And
So
where does
I
that
think
responsibility typically lie within an institution?
I missed the first part of your question, Kristen.
Sorry. Where does that responsibility typically lie within an institution?
I mean, at the end of the day, all the responsibility lies with the board of directors. And
but
so
we know that. But in the reality, at an institution, where does the work, I guess, belong that is reported up to the board on those numbers? What do you typically see, or what did you see when you were at the OCC as like kind of a best practice?
Yeah, it depends on the size of the institution. When you're like let's say 2 billion or higher, and you start to have, say, like enterprise risk committee, that information is surfacing up from the CFO, the chief credit officer, maybe chief lending officer, depending on how that's been broken out. And those are coming together, and then you're putting that information together there. If you're at another financial institution, maybe a little smaller, and you don't have maybe that enterprise risk function, and in the latter example, there would probably also be a chief risk officer, and that person is summarizing the information from CFO, CCO. If you're in a situation where you don't have a chief risk officer, maybe you have your CFO, your chief credit officer, a lot of times this is coming from the CFO with information that's been reported up to the CFO from other departments as required.
And then at what point would you expect an institution, at what asset size or complexity would you expect an institution to have an ERM in place?
That is a tough question, and I don't think it's something that's based on asset size, because it's really based on complexity of the institution. Sure. So I've seen institutions at, say, $1 billion with a full ERM program. I've seen institutions that are at 700 million that are building their ERM program, and then there have been others that are maybe at like 1.5, 1.7 billion, and they don't have that yet. It's really going to depend on kind of the feedback you've been getting from your regulators, and then the complexity of the business you're in. If things are really starting to bleed between business lines, you're missing risk, you're not picking up a lot of that stuff, then it's definitely time to have a program like that. I think they're beneficial solely even from a pricing perspective and a profitability perspective, because you can more easily track the costs that are associated with, say, a business line or type of customer or something like that. When you surface the exposure in every business line, I mean, that goes from like compliance, BSA, to the lending side, to the finance side, and you bring that all together, you can make a lot better decisions on your risk-based pricing.
Right. All right.
Okay. So developing contingency plans based on strategic objectives. So let's say you have X exposure. Maybe that's some municipalities, and maybe it's after that pretty standard balance sheet where you've funded with non-maturity deposits and you're funding, say, 1 to 4 family mortgages and maybe a smaller commercial real estate portfolio, something like that. If your plan is to start expanding into a more volatile deposit source, whether that be, say, money service businesses, whether that be maybe an area that's out of market for you that you don't understand as well, you really want to be developing that plan to consider some of the concentrations that you have coming in and making sure you know when you plan on stopping the gathering for that program. One of the things we typically say when we see people that are building cannabis programs is kind of like a field of dreams. You build it, it will come type thing. I don't actually think that line is from that movie, but I continue to use it.
I looked it up last night, and it's, if you build it, he will come.
See, we're close. We're close.
The more you know, the more you know.
It's good for our purposes. But
Right.
The idea is if all those deposits are coming in, making sure you know when to shut off the valve. You're not trying to flood the liability side of your balance sheet and then potentially not have anywhere to place those assets, place that funding into different assets, and you're putting it into these low risk assets. Might be bonds, but those bonds are rate sensitive. So making sure you really know what you're going to do with the funding and what the limit is of the funding you plan on taking.
Yeah, you make really good points there. I have seen many institutions just get trigger happy and say, oh, this is new and hot at this moment, let's just ramp up a program right now, and they don't have any limits, they haven't done any of the thinking through of what it takes to actually run that program. And I always tell people, don't make the mistakes that I made in my lifetime as a BSA officer, who just took the word and said, from management that said, hey, go build a hemp banking program. Okay, sure. That was needed in our town. The Farm Bill had just passed, and so I built a program from the BSA risk side, while nobody else was over here thinking about the concentration risks, liquidity risks, all of this. And it went from a very tiny program in a week to 2 months later having 100 plus clients. They're the high dollar volume deposits, and all of a sudden there was more work than the BSA department could handle. There were more deposits on there than they expected, which wasn't, was a good problem for them to have at the moment, but they also didn't take into consideration that they put all their eggs in one basket with me, who ran the program from a BSA risk side. And when I left that institution, they didn't have a contingency plan for my departure, so ended up having to close the program, and ended up then scrambling and saying, no, look at all these deposits that are no longer here. And that caused a whole ripple effect. And so it's more than just thinking about from the deposit side necessarily, but it's like holistically, had the proper ERM team been in place to really think through this and not just say, oh, hurry up, let's go do this. You really need to be having a proper plan in place to think through A to Z anytime you're getting any type of abnormal or not just run-of-the-mill client base, specialized program.
Yeah, even if you're not planning on spinning up a whole formalized ERM program, it's still good to try and communicate this information between your business lines, even if it's a little bit less formal, or maybe it's specific to a portfolio or a product type. But that communication is going to save you a massive headache in the future.
Absolutely.
Okay, so unlocking new deposits, maintaining financial stability. I think diversification is always going to be a positive, but sometimes based on our geography or potentially the strategy of our financial institution, diversification can be a little bit harder to come by. For example, when we were in the Northeast, I was an examiner in the Northeast. The Northeast typically has a bit of a more difficult funding profile. Its deposits are very competitive up there. There's more net non-core funding than in other parts of the United States. So as a result of that, there is more reliance on borrowings, and just trying to get non-maturity deposits in general might expose you to less of a diverse set of customers than you would prefer. So sometimes we have to deal with those realities, and it's planning around those realities. So if we do have, say, not the most diverse set that we want to have in the world, well, how are we actually having the funding capacity to offset that if maybe something does happen to that industry, as we saw during COVID with pullbacks, say, on the, well, I guess after all of the PPP deposits, but after that, when we look at like hospitality, tourism, that sort of thing, you did start to see a drawdown in those balances. If you had a massive concentration in that, you had to start thinking about, well, what are we going to do if that does happen? Other ways you might be diversifying could be geography, as we mentioned before. I think geography is a really good one that we want to think about. But potentially, if you start to delve into different business lines, like maybe you're doing small business lending and you hadn't been doing small business lending before, that's opening up the deposits that might be with those small business loans that are coming into your financial institution. Or you're targeting different customer types, member types that have different deposit profiles. So a lot of times we'll talk about with financial institutions that are talking with us from a consulting perspective is, okay, I want to get X deposits from this new venture. And then it's how do we hone in on that specific industry to find the participants that do have more deposits? Because some participants are going to have deposits. Some participants might have more of a allure from like merchant processing or the lending side. So that further segmentation into different industries to make sure you get the things you want and to get that diversification in funding can be really important. If you target the wrong area, you might not actually get those funding sources you're looking for.
Mm-hmm.
And then Kristen, I can let you jump in on that risk assessment one, because I know you're a big fan of the risk assessment side.
Oh, yes. I I have a love-hate relationship with risk assessments, if I'm going to be honest. You know, they are its own beast in itself if you're doing it the right way. However, there's nothing that tells a better story than a risk assessment does on the health of your institution if you're doing it in a robust manner. There is, you know, guidance in the FFIEC manual around risk assessments. But a lot of times, especially we see at smaller institutions where they pick up the manual, the FFIEC manual, if you still have paperback like I do, or they go online and look, and they see this matrix of risk on there, and they believe that's their risk assessment, and they just fill in these little boxes, you know, of the 10 boxes that are there. They say, are they low, medium, or high? And they believe that checks the box. That doesn't tell you anything about the risk at your institution. Now, that's specific to BSA. There should be risk assessments that occur for each line of business. And I say that because a BSA risk is going to look at all the different lines of businesses and concentrations of customers, just different transaction types that occur, different lending options, so on and so forth. But that still doesn't necessarily take into account the very, very deep dives that need to happen maybe in the lending department for the various types of lending that occur at different institutions, whether it's traditional consumer lending, commercial lending, equipment lending, you name it. It needs to have a deep dive understanding and a risk assessment on some type of recurring basis. One of the most interesting things I've heard of recent was speaking with and around some former employees of some of the institutions that had gone south, right? The two that we're talking about in Silvergate. And Silvergate had a very big concentration of FTX relationships or cryptocurrency in general. And they're the ones that have decided to self-liquidate. And in my conversations with several people from there was around, you know, risk assessments. And one of the common themes I kept hearing from multiple parties was saying, well, we didn't regularly complete risk assessments, or we didn't complete them at all. Well, when you have a concentration, or maybe there's a disconnect, or there's siloed departments, and you're just the BSA compliance department and nobody includes you until the very end, or maybe they roll out programs without your knowledge. If they had been properly doing risk assessments, at least the BSA risk assessment, they would have understood and identified that the majority of their deposit funding and some lending was related around the crypto space itself. That there would have been a lot of red flags that were raised there, and maybe there would have been ways for them to help mitigate the risks or roll back on some of the products or services that they were offering. But without that risk assessment, they didn't know. The problem is there are no really good templates out there that exist. It's hard to just kind of, especially if you're newer in BSA, or even if you've been around a long time, where do I start? What do I do? What's the good foundation for me to build off of and really make a true real life story come to life that I can tell my key stakeholders, management, and board, this is what's going on at your institution. These are the ways that we're already mitigating the risks, or at least attempting to, but there's these huge gaps here, here, and here. And I'm letting you know, and I'm bringing it up, and these are the things that we need to mitigate these risks with. So as a result of that, lack of, you know, usable, tangible, real risk assessments out there, we built one at RiskScout for you guys to be able to lay a foundation for building a strong risk assessment. So this is a very high level one. It's located in the handouts of this webinar. If you click on the handouts, it's one of the downloads. You will see the foundation of that risk assessment there. It is in a Word doc, so you can use it, you can utilize it, and it's a good way to start building that foundation for you to really understand where there could be potential concentration risks at your institution that you identify that maybe other folks don't realize are there and need some contingency and strategies built around that to mitigate those risks to your institution.
And if you do take a look at that, or you're taking a look at maybe your existing risk assessments and you're trying to pull in maybe some more detail on the liquidity side or the interest rate risk side, if you look in the, I'm trying to remember which comptroller's handbook it is, it's either the bank supervision process handbook or the community bank supervision handbook. The appendices are going to have those risk assessments that examiners use to determine the quantity of risk, the quality of risk management, aggregate, all of that fun sort of information. And if you want to just kind of comb through there and say, you know what, this one makes sense for adding into maybe this specific product line that we're doing a risk assessment on, or you just want to read it because you need something to help you go to sleep at night, it's probably good for that too. But there's a lot of good information in those. So either the bank supervision process handbook or the community bank supervision handbook, it's going to be the appendices at the end of those.
Yeah, and you just want to make sure that you don't complete a risk assessment to check a box. You actually complete it to understand what's going on at your institution and that that information is socialized where it needs to be socialized, and not just socialized by people who are going to read it and fall asleep at night, that they are going to take it and you have a clear and concise message and summary to those key stakeholders, because we're going to be honest here, guys, their attention span is about, only several minutes long. They need this risk assessment is only one small piece of the pie that they're worried about, or even maybe they don't even know they should be worried about it. You've got to be clear and concise in your summary of your findings and make actionable, real, reasonable, and achievable actionable items for you to complete and recommend so that you're keeping the right parties informed, because it is, again, that board of directors who is ultimately, responsible for what happens at the institution. But if they're not there every day, they don't understand it like you do. They don't know how to complete a risk assessment necessarily and really understand a deep dive in there. So we could, I could talk all day long about risk assessments. I won't bore you with it, but it's extremely important in this whole grand scheme of things. And if you take this one, download it, have questions, please reach out. We're always helping folks just kind of look over them and to provide feedback to them on ways to improve and other things that they should think about.
Thank you for sharing that. Great call out. Again, those are located along with slides. If you would like a PDF copy of these slides, those are all located in the handout section that you can go ahead and download currently. But that will actually bring us to our second poll question of the day, which you should see coming up on your screen currently. And that asks, have you had any customer applicants from recent failed banks come to your institution? And there are three options there. Choose any that you'd like. That is either yes, we have had applicants from these failed banks, no, we have not, or we're not sure if our applicants have come from these failed banks. Give everyone a second here to respond before we share out some of these results. Excellent. Thank you all for your answers. Y'all are quick on the draw today on this beautiful day. So let me go ahead and share these results out. And Kristen, let me ask you this time. Looks like we actually had 20% of our attendees that are here on the line are reporting that yes, they have had applicants come from some of these failed banks. 44% say no, they haven't, and 37% are kind of in that nebulous area. We're really not sure where these applicants are coming from. How does this stack up with what you were expecting?
I'm not surprised by it. We have had so many so many consulting agencies and institutions reach out to us to say, what can we do to help these businesses that are looking for a home? Or we're getting so many asks for helping these guys, but we don't even know where to start. So it doesn't surprise me that at least 20% have had applicants from there. It's really interesting to me, the stories I've heard too about how some of these really large depositors are going to the big, too big to fail institutions, trying to deposit millions of dollars from SVB that they had there from maybe their VC company or a startup or one of those tech companies. And then those businesses are being turned away. And it's because those big banks are overwhelmed by all of this, don't want the deposits, or don't have the ability to act swiftly and change and shift gears like maybe a community financial institution can do if they have the right tools or right people in place to do it. So it does not in the least surprise me. I get asked all the time, even what now, 3 weeks of time is a blur at this point, that do I know of any institutions that are looking to bring on some of these guys?
Thank you for sharing that. Thank you to everyone that responded. Let's actually talk a little bit about what vetting those new applicants maybe should look like.
Yeah, so when you're looking at any type of applicant, it's always about, does this business or this person align with our institution goals and our risk appetite? So you, if you are getting into any type of account opening where you're advertising that you're bringing on maybe a new vertical, or you're just wanting to help out these businesses that are looking for a new financial institution to bank with, there's a lot of that waterfall effect, right? You get these businesses, and this happens about in every vertical that there is we know it's a large set of businesses, and we find that we end up getting it, they end up being a much smaller knit communication-wise community. So you onboard 1 or 2, they spread, that information spreads like wildfire, and before you know it, it's a waterfall of applications. So you want to ensure that you are filtering for applicants that fit your risk appetite and your financial institution strategic goals. You want to be able to not only filter for them, but you want them to also, you want to ensure that these customers or these businesses, applicants, are who they say they are, right? So you need to also be able to verify that they are the businesses that they say they are, and that they do really truly fit your risk appetite and your institution goals. But these guys were in a hurry to go bank somewhere else, and some of them still are scrambling to go find a new institution. And we may find with the SVB transfer of accounts and loans and whatnot over to First Citizens, that they may not like banking at First Citizens. It's a different environment over there potentially. So you will find that the quicker they want to move, the quicker you move, the more likely they are to become a sticky customer at your institution. So you want to be able to decision applicants quickly, have a quick way for them to provide you the information and then decision those relationships as to whether or not that you want to, so they can quickly move on if you decide they don't fit your risk appetite. And you want to make sure that the applications that you are providing these businesses are really robust and really targeted to what you're trying to find out about the business, so that you can make better, more risk-based informed decisions.
Perfect. That is super helpful. I think that does take us into actually a quick demonstration of a vetting tool that RiskScout sprung up for this very purpose. So Kristen, I'll actually go ahead and throw the screen over to you so you can give us a quick walkthrough of what it actually looks like to see this in action.
All right. Can you see it, Ethan?
We sure can. It's looking great.
Perfect. All right, y'all. This is RiskScout's onboarding and verification tool that I'm showing you. There's a lot of other features in RiskScout. This is specific to our application and verification process. When the SVB incident happened on a Friday over the weekend, we were able to build this application process and a verification process over a 24-hour time frame. So on Monday, our institutions had the availability to have this application available to them to be able to have these businesses seeking relationships apply at their institution so they could quickly onboard them and get them in the door. I've not worked for other tech companies, but I have used tons of tech companies in my 20 years of banking, and I've never had anybody be able to turn around something this quickly for me to utilize. So our institutions were grateful for this opportunity to bring on additional deposit revenue into their institutions. This is our application process. I, for sake of time, filled out the application for you guys to see, but the application is specific, mostly was specific around SVB type relationships, which ended up being very heavily tech startup businesses and maybe venture capitalists. So we targeted the application process to think of all the risks that could be associated with those and all the things that the institution would want to know prior to onboarding. They are able to send out this application by private invite only or through a public facing link. Some of them like to add the public facing link on their website and target these specific businesses that are looking for a new financial institution. So those businesses can get in and click on this specific application, and it takes them to that white labeled login for the business to complete an application and submit it back to the institution. This business received the application and they were able to quickly fill it out. It is all pretty user-friendly, walks you through the whole process. They submitted it back to the institution. They are not allowed to skip any areas that we required. Once it made it back to the institution, we completed what is called a first pass report, which is a verification report. The verification report is a risk-based risk information report. So we're not going to tell you whether you should or should not bank somebody, but it does allow you to get a more informed information back based on the risks that are associated with these industries. And anytime that we mark something as potentially a red flag, we'll mark it as investigate and provide the supporting documentation at the bottom of the report. The nice part about the application process is that you are able to route an entire application back to a business should they have not given you the entire information that you had desired. Maybe they only gave you a couple words here and there and answers more vague, and you want to submit the whole application back to them. You can route it back to them with a note that's saying, please be more thorough, or whatever your language is that you want to use, and they can resubmit it back to you with no issues. But if you have just maybe one or two follow-up questions that you want to discuss with that business, you can send them a task directly with a due date. You can require an attachment. Once I assign this as the business, I immediately get a message back that says I need to log. I get an email and I get a notification saying I've got something the institution needs. I can respond back. That is sent directly to the institution. The institution gets a notification, and this message thread can go back and forth as many times as you want. So it's just it's a nice way of quickly getting through an application process, a decisioning process, to ensure that these businesses fit your risk appetite, they are with your institution's program goals, and that you're getting all the information that you need. And it creates a good customer or member experience that they're able to quickly get into a new institution and have a decision made quickly on their business.
Thank you so much for sharing that with us here. I will go ahead and take the screen back. And I think we've got some key takeaways here before we get into the Q&A.
Oh, Ryan, you're on mute.
No, I'm not.
Nope.
Okay. The main takeaways. The cause of a lot of these collapses, I mean, most of these collapses were bank runs and some sort of concentration risk on the liability side of the financial institution. To reduce risk, what we talked about is creating a robust contingency plan, identifying any of those concentrations, whether it's a sub-concentration or a broader one, trying to diversify between different types of deposit and funding sources, and then performing risk assessments before we enter into those new markets, thinking about the impact from really any part of the financial institution. So whether that's the financial side, whether that's a compliance side, whether that's maybe on the lending side, I mean, there's impact we can have all over the place. So just making sure that's holistically thought of when thinking about a new product, market, or area that you might be entering into. Then lastly, thoroughly vetting applicants to make sure that they're aligning with your strategy and your risk profile. One of the things we talked about earlier was, say you are trying to grow that deposit base with some sort of industry. One of the things you might be wanting to ask then is making sure that the customers or members are part of that subset of the industry, so you get the type of customer member that you want at your financial institution.
Yeah.
Perfect. Thank you so much for that conclusion. We do have some Q&A that we'll dive into. As a reminder, we have the questions tab on the right side of your screen in the GoToWebinar control panel. So if you do have anything you'd like for our experts to answer here today, please go ahead and take that opportunity to submit some. And while we kick off our Q&A, we'll actually launch our third and final poll question, which should be coming up on your screen now. And that question asks, would you be interested in speaking with RiskScout about any of the following? Just a quick opportunity for you to raise your hand and let us know if there's anything else that you'd like to dive deeper into based on what we discussed today. You can select as many or as few of these questions, and I'll go ahead and leave this up as I go ahead and ask some of the questions that we have received. So Ryan, I know we talked about this a little bit, but one of the questions that we received from our audience today is about ratios, asking what new ratios should banks be monitoring for to ensure that they don't meet the same fate as some of these failed banks?
Yeah, that's a good question. It's funny, I think the word new there might be unnecessary for a lot of this. One of the biggest things to look at really is your basic surplus. So the basic surplus is a liquidity measure. It's going to show the total liquid assets you have less the high risk, high volatility, total liquid deposits you have, total available liquidity, less the high volatility, high risk deposits you have. And then you're looking at that as a percent of your total assets. A lot of times we'd see this somewhere between maybe 8 to 12% of assets at the financial institution. And when you look at that number against maybe some of the exposure you have on the asset side from, say, unrealized gains or unrealized losses rather, you can start to figure out, hey, is this basic surplus really appropriate for the level of risk that we have on the balance sheet side? Another one to look at is on the sensitivity side. We talked about economic value of equity. I know, at least from when I was an examiner going into financial institutions, the conversation was usually, let's look at earnings at risk. So the amount that is going to affect on, say, net interest income and the amount we're earning per year versus the economic value of equity, because economic value of equity is the theoretical liquidation value. Now, when we start to see a bank run, that's when that theoretical value really is more important. So there is a reason to be looking at that ratio, despite the fact that a lot of people want to push it off saying that it's theoretical, at least from a looking at it in like a break the bank scenario or something like that. When you start to look at the financial institution and say, what situation would have to happen for us to really be in a bad spot? And that can be a good one to drive some of that thought.
Thank you for that, Ryan. We also had a question asking, how should I manage concentrations of deposits related to specific industries and the board reporting that goes along with that?
Yeah, also a great question. So related to specific industries, I think the first thing to do is make sure that some of the sub-segments that you're probably monitoring as a concentration roll up into their broader segment. So I would imagine, and I haven't confirmed this, but this is just kind of a guess, when we're looking at Silicon Valley Bank, the concentration pools are probably into different industries. So you might have a lot of different startups, but those startups are, say, in engineering, fintech, agriculture, whatever it might be. But they might have a common risk factor in maybe relation to venture capital or maybe size of the business. So trying to identify what those broader risk factors are and making sure things line up to that. Now, Monday morning quarterback, that's really easy to do. Looking at your actual deposit base and saying these are all linked together is a little bit harder when nothing's gone wrong yet and you haven't seen how they're related. So that takes a little bit of introspection, making sure that those all roll up to a similar place. Another one where we're just outside of the industry side of things, just reporting on the amount of deposits that are over that $250,000 threshold and showing, what is that level of high risk, more volatile deposits relative to our non-core funding sources, and making sure that we're able to offset maybe departures of that with different funding rather than having to liquidate assets that might have some of those unrealized losses on them. And on the reporting side, we touched on that a little bit before, but I would recommend that sort of reporting quarterly with early risk warnings that say, we're approaching some of these different ratios. What are we going to do to make sure we don't go over them? Or if we're going to change the limit, how are we going to change it? Why are we going to change it? And what controls are we putting in to make sure that's not exposing us to more risk than is appropriate?
Perfect. Thank you so much for that, Ryan. It's super, super helpful, a nice and in-depth answer. Kristen, I think we've got one that might be more in your ballpark here. This is just a question asking, it's the failed bank applicant vetting tool that we just reviewed earlier. Does that come along with the existing RiskScout subscription that I already have?
Yeah, absolutely. We rolled it out to all of our institutions, regardless if it's what they had originally planned for, right? Some of our institutions do a numerous amount of different type of verticals, including cannabis, hemp, crypto, ATM, money service businesses, politically exposed people, anything under the sun that causes a bigger regulatory burden or just, they need a better process internally, then that's what they've contracted with us. But because we had such an immediate market demand that we knew this was going to come out, we did it as complementary to our institutions and quickly pivoted to help them out, be able to help out their communities and these businesses that were seeking help.
That's awesome. Thank you so much, Kristen. I think we've got time for one more question here. Ryan, we got actually a few questions around Silvergate Bank and how they fit into all this. Do you think maybe you could speak to that a little bit?
Yeah, definitely. So I think everyone's seeing a slight distinction between Silvergate and then the situation that's occurred at SVB and Signature. And part of the reason for that is when we look at Silvergate, the concentrations were just way, way, way higher. The concentrations at Silvergate were primarily crypto. I mean, Silvergate was known as a crypto bank. At one point, I want to say 85% of their deposits, if not more, were all related to crypto. And then 10% of that was related to FTX. So when you saw the FTX collapse and then a lot of the turmoil in the crypto space, their deposits fell from, I want to say it was 14 billion in Q3 of 22 to about 7, maybe 6.6 to 7 in Q4 of 2022. So their deposits almost halved within a quarter. And then they chose self-liquidation because I'd imagine the immense drawdown of the liability side of their balance sheet, the pressure from regulators, probably not a situation that's incredibly easy to deal with. And for them, they self-liquidated instead of having to go into receivership. It was a bit of a slower bleed, but a lot of that was stemmed primarily from turmoil in the crypto space. And then
Thank you for that.
All of them are bank runs, but different ways.
That's true. A common thread, to say the least. Means we all need to go brush up on our It's a Wonderful Life, it sounds like. Well, excellent. Thank you so much, both Ryan and Kristen, for answering some of those questions. And thank you all in the audience for joining us today. It means a whole lot. And again, a big thank you to our presenters for taking the time and sharing some of their expertise with us. You should go ahead and keep an eye out on your inbox because we will be sending out all of the resources, including the recording of the session, the slide deck, the risk assessment, everything that you could need later this week for your convenience. If you do have any additional questions or if you asked one that maybe we just didn't have the time to get to today, don't hesitate to visit us at riskscout.com. If you want to learn more about us or if you just want to swing by and say hi, you know where to find us. Thank you so much. We hope to see you on next month's webinar and enjoy the rest of your day.
Hi, everyone.
Thanks, everybody.